Steve Nadel. Seward Kissel is out with its new hedge fund study. And one of the big trends that you found is that investors are getting lower fees when there's more assets in the fund. That seems fair to me.
This is a really interesting development, and I was surprised when I had seen it. You know, you can't see the forest for the trees sometimes. And when we did our study, which we've been doing now for about 5 years, we discovered that about 20% of all of the funds that we studied had a tiered management fee, basically, which means that, let's say you start out at 2%, as assets increase, the management fee goes down. This is driven by the comments that we heard from a lot of pensions in the mid to late 2000s, where they were concerned that you had a big management fee and it was a profit center for the managers.
And the other big trend you saw was that more equity funds are popping up. You think this is a little bit late because stocks have been doing well the last few years? Maybe it's probably time that they cut back.
It's an interesting point. You know, long only was the way to go last year, and I think people were sort of jumping a little bit on that bandwagon. And overall, equity funds in the hedge fund space did better than credit and multi-strat. I think this year you're going to start seeing a change. We're already seeing some of our clients in the credit space and some other spaces like commodities looking to do stuff, especially around oil and the energy sector.
What about lockups? How hard is it to get your money back?
Lockups, not as bad as they used to be, I guess, so investors will be happy about that. About 20% of funds now will allow monthly or more frequent withdrawals. I've even seen one recently that was a weekly withdrawal fund. Gates have almost gone away, at least on the fund level. We still do see some investor level gates, though.
And speaking of 20%, that's still the profit benchmark, right?
20% is still the way to go. That's what we see. However, I will add that sometimes if a manager has a class where if you agree to lock your money up for a longer period of time, they may give a discount. So instead of 20, maybe it'll be 17.5. We also saw in the study an increase in founders classes where 65% of the funds in the study gave discounts on both management and incentive fees if you were a day one investor, usually up to the first $100 million into the fund.
So finally, how much does the fact that so many hedge funds closed last year feed into these lower fees and looser lockup periods? Is the hedge fund industry kind of finally figuring out, well, we may have to become a little bit more fee and investor friendly?
I think that's right. I think managers are starting to listen a lot more carefully to what investors want. Investors, on the other hand, are also becoming sort of almost more unionized. Last year, the AOI, the Alignment of Interest Association, came out with their own sort of best practices in terms of investing in hedge funds. And I think now if you want to attract institutional money, you have to start listening to those institutions.
All right. Thanks a lot, Steve.
Thank you for having me. Appreciate it.
And thank you for watching The Street.